We're going to go over the markets. We're going to go over the Williams percentage range, how I use it, why it's so beneficial to use, whether you're running my setups, the high five trading strategy, or whether you're running your own strategies. Whether you're investing or trading, it doesn't matter. The Williams percentage range can really, really help you in becoming a better trader or investor and just understanding where the markets are going. And then finally, we'll just do a Q&A. So without further ado, let's just roll from the top to bottom. QQQ. Obviously, if we look at the 15-minute, we had a pretty steep drop off in after hours on Friday. We had this pretty steep drop off. It was about almost a 1.5% drop off on the QQQ. That was all due to the Moody's downgrade of the United States credit rating. With that whole thing, guys, Fitch, S&P Global, they've already downgraded. Like Fitch downgraded in 2023, and then S&P Global like 2014 or some craziness a long time ago. I think with the volume and where everything's at right now, I think we are already gonna get a pullback this week, but I think the pullback gets bought up. I think the pullback gets bought up. We do have our hedges on, so we did get into some hedges. If I pull those up, we got into the May 23rd, so expiring this Friday, 515 puts for $5.48. That is going to be $1,646 spent. Nothing crazy, just a small little hedge. And that break even's essentially going to be basically 509-ish. So if we did get a rapid pullback, right, and say we did, have a big drop this week, let's just say we were going to drop, 5% this week to fill this 493 gap. Well, those options would be up, over 100%, maybe 200-300%. So that's why it's called a hedge. It's just essentially saying, okay, we're pretty long in the markets right now on our long-term investing, and we're long on our trades, right? So let's hedge up against our portfolio. That way, if we do get some sort of a pullback, which we were already starting to believe that we were going to get a pullback into this week because we have been running so hot. Running so hot in the terms of we've literally ran 27.61% in a very short amount of time. We were literally talking about since April 7th. So today's May 18th. So basically a month and 2 weeks, we've ran 27.61%. The market doesn't even do that in a whole year. The average return on the S&P 500 on average is 8 to 10% per year. So having this massive move up of 27.61%, it's amazing, but we do need a pullback, right? We do need a pullback, and the pullback that I'm looking for would probably be to the 25-day moving average right here, this purple line, and that would bring us back to 500. We could also get a shorter pullback, maybe, what's this, a 21 EMA on the weekly, could come back and fill this gap, like I said, down to 493, but I don't think it's just going to be in a straight line, just fall off a cliff. I think it's going to be some chopping, and we did get back into this bullish channel, so it could just be a pullback right back down to here to about 510, where we bounce, and then we get back into this bullish channel to the upside, and this was just basically, a quick correction. The biggest thing I want to tell you guys is I'm not an oracle. I don't know what's going to happen. All we can do as traders and investors and technical analysis experts, whatever you want to call it, all we can do is look at the charts and understand the possibilities. Getting in a game of predicting where the market's going to go, then rather than reacting, is a very tough game to play, as you know what trading is already. So we obviously want a continuation higher. We want to continue to move higher. This volume this week has been, or the past 4 weeks has been very good. We were declining volume on the way up, and then we spiked, and then we've had the largest volume that we've had out of the past month. So very, very good volume in this market on a weekly basis, on a daily basis. It's been very good volume. It's been above average, obviously, consistently above average. And, ever since this consolidation period, we've just been steadily climbing up. So if we're looking on a daily chart, right, because I think the weekly chart is going to continue higher. If we're looking on a daily chart, obviously, number one, we could pull back to the high 5S indicator, which is the daily swing indicator for the high 5 indicator, and we could easily pull back down here to about 506.62, somewhere in here. Just get a little bit of a pullback. Like I said, if it was a deeper pullback, we could pull back down to fill this gap. We would be right at the 100-day moving average and right at the 200-day moving average. So it is very possible, and the 21 EMA. So 21 EMA, 200-day, and 100-day moving average could all be knocked out with one single blow down here with this pullback to get us that retest, which would be about a 5-6% pullback before we would go ahead and probably march higher, right? If we cross down below the 200-day moving average, then retest and fail the 200-day moving average, then what we are actually in is a bear market. And this whole rally was just a bear market rally because we had our high, we topped out, had our double top, came down, had a small little rally, made this bear flag, broke down, had this very, very big drop with very big drop with tariff talks down to April 7th low, had a big rebound off of Trump pumping the markets, then a higher low was formed, and then a higher high, and another higher low, another higher high, another higher low, another higher high, and now what we want to see is another higher low being formed here, because if we form another higher low right around here and we bounce, that means we're back to bullish, full-on bullish, not just a bear market rally in this market. And if so, we come up here and make a higher high after making a higher low, then we are so back. We are so back, okay? So back. Like, I'm talking, like, we are going to, if that happens, we are going to break over all-time highs either in May or June, right? And we're going to see new all-time highs like 560, 580, maybe even 600 this year, which would be absolutely crazy. But you have to understand that all the tariff stuff is really starting to wind down, and that was the reason for all of this. The tariff fear, the FUD, fear, uncertainty, and doubt that was put out there because of the tariffs, that is what caused this massive correction. And it was a correction. It was 20-some% peak to trough, right? And now we have come out of it. And now is the time where we really, get down to brass tacks. Is this a bear market rally? And then the next leg's going to be lower? Or is this going to continue to make higher highs and higher lows? And this next pullback, due to Moody's or whatever, is going to just be that. A small pullback of, 3 to 6%, making a higher low, and then making a higher high with a bounce. And there is $7 trillion on the sideline right now to buy the dip. Rates are going to continue to come down. I don't know when, but we should get rate cuts this year. And as rates continue to come down, that means money market funds go from 4% down to 3%, down to 2% on the interest that people are getting on their money. And as such, right? As such, they're going to pull out their money from a 2 to 3%. That's it. That's all I'm getting on my money now. I was getting 4 or 5%. They're going to pull out their money. And if markets are moving higher, they are going to pump that money into the markets. And that creates FOMO, because now markets are moving higher. I'm sitting here in a 3% or 2% money market funds, and the market is moving higher, and people are making 100% plus on HIMS in a month. It creates FOMO, everybody. And FOMO leads to higher in the markets. Not just that, but hedge funds were selling all in here. Hedge funds were selling all in here, and then they only started buying, pushing us out of here, right? They only started buying when we were pushing out of here and making higher lows and higher highs. And some hedge funds still haven't bought whatsoever. So there's a lot of hedge funds that are off sides, and they're going to need to answer to their clients on why they're not making money when the market just had this amazing 26% rally. So a lot to unpack there. The only other thing I'd like to say, basically what I'm saying is, we could get a small pullback of, 2 or 3%. We could keep running. We don't know. We don't know what's going to happen. Monday, Tuesday, we'll really understand what is going to happen, because we're going to understand, what type of effect that the Moody's news has. I don't think it's going to have that much of an effect, or shouldn't have that much an effect, but it could be that one trigger point that does cause something to happen. So again, I'll say what I believe is most likely to happen is a small pullback Monday and or Tuesday, and maybe the whole week, of anywhere from 2 to 6%, and that's in a range of 520 all the way down to let's call it 490. So about a $30 range on the QQQ, and again, that would be about a 2% to about a 6% pullback that we could see. If we do see that, our long positions are going to take a bit of a beating. Obviously, if we get a 2 to 6% pullback, like our long positions are going to take a bit of a beating. But while they're taking a beating, and as long as they don't invalidate their setups, as long as they are still good, then we can continue. We can add more to those positions, and we can also get a really great dip buying opportunity in the overall markets with our margin of safety percentage strategy, and buy into more companies at a lower price range. So, yep, 520 to 490. I know that's a huge range, but again, we're looking for either worst case scenario, a move down to the 100 and 221 100 200 day moving average and 21 EMA, and that would be a good bouncing point. And it really depends on what happens there, right? So do we bounce and then make a lower high and then continue to fall through it and then retest that 200-day moving average? And if that happens right there, then we're in a bear market, and you better expect us to at least revisit April 7th lows or break and go lower than April 7th lows. And in that case, we're just going to watch all this and watch what happens. And we're just going to be ready on the trigger finger to fully exit all of our trades if we do get confirmation that this is just a bear market rally and we need to exit our trades. And on top of that, we're going to just sit back and watch our individual stocks, individual trades, and sit there and engage whether or not those should be we should be exiting those, right? I typically don't talk about the SPY that much, guys, because the QQQ and the SPY, to me, they're basically the same. And everything that I just said for the QQQ, the pullback areas and everything, it's the same thing for the SPY, guys. It's all right in here, where we have the 100-day, 200-day moving average and 21 EMA. It's all right in there that we could get a pullback down to. So it's all the same. It could be across the board. What I will say is on the daily, on the QQQ and the SPY, we have these beautiful Williams consolidation boxes formed. And what a Williams consolidation box is, if you're new here, is basically you run up to the red barrier. The red barrier, if you scroll out left, the red barrier is the highest point that the Williams percentage goes over its history. And the green barrier is on the bottom, and that's the lowest point that the stock in the Williams percentage range goes over its history. You run up into negative 20 up to the red barrier, and then on that first big pullback, that is going to be your support. Once that support is made and you bounce and you come back up above negative 20, you have now formed your Williams consolidation box. You've never heard of this before because this is my personal strategy with the Williams percentage range. The Williams percentage range, I didn't create this indicator, but the Williams consolidation box strategy and how I use it, going like a pendulum swinging one end to the other to catch momentum and then continue to catch momentum with the Williams consolidation box. A lot of people use divergence, bullish and bearish divergence, and I agree, and that's a great strategy. Just my strategy uses a box, and you come up here, you create your first low, and now you have your Williams consolidation box. When you form that Williams consolidation box, you're basically saying, okay, we are bullish because, let me talk about this real quick. Above negative 50, you are bullish. Below negative 50, you are bearish, okay? Downtrend, uptrend, okay? And obviously it differs between the daily, weekly, and monthly. Obviously, if you're below negative 50 on the monthly, you are in the doghouse. Like, you are very, very bearish. If you are below negative 50 on the weekly, you're most likely bearish as well. And especially if you're going down, not up. Okay. And then on the daily, you know, obviously you guys see this, it swings and pops around way more than the weekly or the monthly would. So you just need to take that into consideration. But essentially, as long as, so if there's a bullish Williams consolidation box. So basically right now, as long as we stay within this bullish Williams consolidation box on the daily and continue to not break this low and continue to come in and just bounce back and forth like a crazy person in a room, the QQQ in the markets will continue higher. They will. A perfect example of this is right here. Williams consolidation box continued higher. Once we broke out of the Williams consolidation box, we had a decent sized pullback, and then we had chop on the way down, obviously. Sometimes they're really, you know, sometimes they're huge and they last a while, right? So this one lasted a while there, and then we had a huge pullback. And again, on the daily, it's going to move, you know, more easily back and forth than on, say, like the weekly. On the weekly, if you look at the QQQ, you build this Williams consolidation box right here. Look how massive of a move you would have caught being in this Williams consolidation box here, right? So you ran up here on your bullish momentum. Your first pullback created the bottom of your Williams consolidation box, and you stayed within this until you finally broke out here on April 8th, 2024. So from October of 2023, right, was when we started going bullish, had our green barrier, pendulum swinging from green to red, built our Williams consolidation box. And what happened since building that Williams consolidation box? Well, we went from about 350 on the QQQ all the way up until we broke out of the Williams consolidation box on April 8th. Right here, we broke out of the Williams consolidation box. So you went from about 350 all the way up to a peak of 447, and you broke the Williams consolidation box right at about 437. So you basically gained $100 a share on the QQQ following the Williams consolidation box strategy. You see how that works. Same thing here. Williams consolidation box strategy is built, and we just run and run and run and run and run and then stop. We broke out of the Williams consolidation box. We got a pullback. And then we swung down to the green barrier. The pendulum swung down, and then the pendulum swung right back up, formed another Williams consolidation box, and bada boom, bada bing, we're off to the races. So what does all of that have to do with where we are right now? Well, first things first, we are in a Williams consolidation box on the daily, but we are up here towards the top of the Williams consolidation box. We are running into the red barrier on the daily, which means on the daily we should get a day, a few days, or a couple days of pullback. And again, that would look like a 2 to 6% pullback. And if we get that, what's going to happen is, so let's just look at this right here, right? We went from right here, we were at the peak of the red barrier, then we had a pullback down to the low of about 2.88%. So almost 3% pullback we had to get the Williams percentage range off the red barrier down to the bottom of the Williams consolidation box, forming that. We don't have to come all the way down to retest that again. We could come down a little lower. So that's why I'm saying a 2 to 6% would be good enough. I would say 2 to 3%, we would still be in the Williams consolidation box. If we get more than a 3%, then the pendulum is going to most likely swing down to the green barrier. The green barrier, this would probably be that 5 or 6% mark on a pullback. And that would also be right here with the 100 and 200 day moving average and 21 EMA. So it really just depends on what's going to happen here. But we are looking and do expect, a pullback down here somewhere, right? I mean, we could just keep chopping right up here, but eventually you're going to get that pullback. If you look at the weekly, right, you can see that we swung from one end of the pendulum up here all the way down to the lows of April. And now we swung back up to the red barrier from the green barrier, like a pendulum swinging back and forth. Now, the thing is, the market is overall bullish way more than it is bearish. So you see this, right? 1, 2, 3, 4. The past 4 times in the past 2 or so years, we can even go back here. 1, 2, 3, 4, 5. The past 5 times in the past 3 years that we came down on the weekly Williams percentage range and tested the green barrier, we bounced and did not look back. We bounced and did not look back. The only time that was different was when we had an actual bear market, right? So in this bear market, we went from red all the way down to green, and then we built our Williams consolidation box. Then we broke out of that, had this fake out right here on this bear market rally. But look at this bear market rally. This was a massive bear market rally, 8%, 2%, 0.7%. So it was about a 10, almost 11% bear market rally there. But then it got just waterfalled and then built another bearish Williams consolidation box, stayed in there, continued lower. And then here we had this big move of 5, 4, 7, 8, 13, 15, and let's call it 18, 19% total. 18, 19% move. We came all the way up to the red barrier and then immediately swung right back down to the green barrier. So I'm showing you all this for a few things. You see what happens when we're in a bear market. In this bear market rally, this big one here, right, that came right before we basically bottomed out and then continued a new bull market. The thing I'm telling you, though, is out of the past, let's say 1, 2, 3, 4, 5 times we've touched the green barrier. It was just a one-time thing, and then we went all the way back up to the red barrier, filmed the Williams consolidation box, went higher. 4 in the Williams consolidation box, went higher. 4 in the Williams consolidation box, went higher. Formed a Williams consolidation box, a little bit of a fake out here, but that was a topping that we had before this last drop, and then went higher, topped out, had a massive fall, and now we have had a massive move back up here. So I'm saying all this, if we take the probabilities, right, the probabilities say that most likely we will form a Williams consolidation box up here on the weekly. If we don't form a Williams consolidation box up here on the weekly and we roll back over and cross -50, the chances that we are in a bear market just increased massively. Massively increased that we are now in a bear market, and we will not just retest the lows of April, but we will crack through those, and we will most likely retest at least the 200-week moving average. Okay, you see how that works? You see how that works? Because the only other time in the past, what is that, 4 or 5 years, that we formed a bearish Williams consolidation box was during a bear market. And the only time that we ran up and then came back all the way down without continuing higher, just a small little pullback, not a bear market, right, was this time back here in 2022 during the bear market. So this is what I'm saying. We take the probabilities that more than likely we will create a Williams consolidation box. We are due for a little bit of a pullback here, but don't get me wrong, this Williams percentage range, that is only a little bit of room left, but it can slam into the red barrier and move a little bit more and then top out and then have the pullback. So just because we're almost there doesn't mean that we can't go a little bit more on the weekly. So this week could still end a little bit higher. And if that does happen, then I really will be looking for a bigger pullback. Okay. If we get a pullback here, then we most likely get down to here this week. And that would be perfectly building our Williams consolidation box. And then we can continue next week, this week, and then that week after the next week, continue higher there. Okay. So I hope that makes sense. And I basically just killed out the market overview and the Williams percentage range in two, explaining how it works by looking and analyzing the markets. So there we go. I just knocked out the Williams percentage range and how it works and why it works and the Williams consolidation box strategy all in one. And if we look down here at the other indicators, the reason I'm also still very bullish on this market, guys, still very bullish. A couple things here. Okay. I understand the whole Moody's thing. I understand that. But here's the thing. The last time that we made a bullish upward cross like this, so let me take these other indicators out of here. All right. Oh, gosh. Well, let me do this. There we go. Take that. Take that. All right. We're just going to really zoom in on this one, okay? Okay. You see how potent that bullish cross is? We had a red weekly high five indicator. And then we flipped to green. And not just we flipped to green, this yellow orangish line right here, that is the smoothing line. In the smoothing line, you see when we broke through the smoothing line, we continued down. And now we are doing the opposite of that. We have a beautiful cross straight up, almost 90 degrees, just straight up through the smoothing line. That is so bullish. So bullish. The last time we saw that exact thing, right? We have to go back to, I don't even count this. I don't even count this really as that because it's not straight up. It's kind of sideways and we are already in this chopping area. We're not in this chopping area now. We've just been running hot, right? And even this bullish cross led to all of this move up, right? Let's zoom back out a little bit more. And again, you could say this one, but it wasn't as defined. It didn't come down and really get away. It didn't get away. You see, it just kind of stayed together. Just kind of stayed together. The high five and the smoothing line indicators, they just kind of stayed together. That's not what we're looking at. We want to see a definitive pull away, then come back and get right through that. Break right through that, right? You see how far back we're going. This should really tell you, right? We had a small pullback, almost broke it, almost got down. Oh, we're bearish, and then right back up, right? And then we go down here. And again, we had a small pullback in 2023. We broke through it, but we didn't really pull away. Again, stayed very, very close, tight knit, right there, keeping it all together, very close. Then made a small little bullish cross, and then boom, big run up. So let's zoom out some more. Let's zoom out some more. Zoom out some more. All right. So we go back here. Okay. We had a bearish cross. We went down. We snapped back up. We didn't cross. We went down. We came back up. We finally have our bullish cross in which we ran a good bit. And if we look at the Williams percentage range, we ran up to the red barrier. We ran a good bit. And I would say, this is similar to the last one. Now, again, it's just going to depend on what happens here. Because that was a 24% point. That was 24.43% rally. So it's very similar to the rally that we are having right here, right now. And so what's going to sit there and tell us that this cross is a bear market rally, or this cross is going to reward us heavily and send us into the next bull market, right? Because if we roll back, when we got this bullish cross in COVID times, right? Just straight up, and we ran and ran and ran and ran and ran. Crazy move higher, right? So we have two scenarios. Are we in COVID times? We got such a sharp snap down pullback, and then we ripped right back up. And I would say that the tariffs reminds me more of COVID, because that's a one-time thing. Boom, it hits you. Oh my gosh, the world is ending. Tariffs, they're going to cause all these issues. Oh my gosh, fear, uncertainty, and doubt. And then next thing you know, everybody's a little bit numb to them now. And we have deals going on, and we have the trade war that almost begun between us, the US, and China, and it's calming down, and it could still turn on a dime and go back to being bad. But I don't think the administration will let that happen or wants that to happen, because that would be very, very bad. Very, very bad. So it reminds me more of this sharp shot down, because this year has been just a sharp shot down, more so than down, up, making lower highs and lower highs and lower lows. So yeah, but I say that not in like a, just speaking my opinion. I don't know what's going to happen. I don't know. If it's this, we're going to make a ton of money on the way up. If it's this and we're topping out, well, then get ready, because we're going to go lower than April 7th lows. And then we might finally bottom. Okay? Because this big of a bear market rally will typically happen before your final big leg down below April 7th lows we would get, right? And then come back and go a little bit higher, and then we're back in a bull market. So again, I don't know, but we just have to react. We can't sit here and try to predict. We can sit here and look at the possibilities. We can sit here and look at everything that's happening, but we do need to not sit here and say, I predict this is going to happen. I'm going to put all this money on this. That's just dumb. That's just dumb. We have hedges for that reason. We have our long-term investments, and we have trades. If we have to exit the trades and we lose some money on the trades because the market did say, hey, this is a bear market rally and we're going lower, then we're going to listen to the markets and we're going to exit all of our long-term trades. Will we get hit? Will we lose money? Yes, we will. But the market could also sit here and say, nope, this was just like COVID, back on the bull market ride, and we're going to make a ton of money after a small little pullback, right? So yeah, we're getting the bullish cross. Like I said, we could see a retest of the high five indicator on the weekly, and I would rather have that because that'd be a smaller pullback. We're talking about, well, that's like, yeah, 2 to 6% right there as well. But yeah. So we just got to see how it plays out, guys. And like I said, the biggest indicator is going to be the Williams percentage range. You see, when we broke out of this one, made this bullish cross, what happened? We built a Williams consolidation box and we kept riding that higher until we broke it and then had a decent sized pullback here and here. With this one, we just went straight up and then came straight back down. There's not going to be a forming of the Williams consolidation box. It's going to be where we are at right now, right? It's going to be, oh, we're here. We had all this bullish momentum. We're here. And now we're going to top out and come straight back down like a pendulum swinging right back down to green. Okay? But another reason that I don't believe that's going to happen is because, and again, it could happen. I'm ready for either outcome. I'm just saying I don't believe it's going to happen. Huge buying volume, above average buying volume on the weekly. Bullish cross on the high 5 indicator. We're back up here, and more times than not, when we go from green to red, we form a Williams consolidation box more times than not. Are we really going to have another bear market within a 3-year time frame? Maybe, but maybe not. Okay. We are climbing higher on the histogram, just printed a green histogram. We are crossing on the MACD bullish, and we are about to cross the 0 line. When we cross the 0 line, that is very bullish. The last time we crossed the 0 line, guys, was all the way back here in February 2023. We crossed the 0 line. We made a bullish cross on the high 5, and then we proceeded to run hot and heavy for a while to the upside. And before that, the last time we crossed above would be basically, here back in 2020 or here in 2018, with small little dip down and then we shot back up. Small little dip down, then we shot back up. This is a bigger dip down, and now we're about to cross the 0 line. And the last time that's happened in a big way was coming out of the bear market in 2023. We almost got there here, but not even close to where we are now. We were like right at the 0 line. So if we're comparing to the bear market, to the last bear market, the MACD is not comparable to that bear market. This tells us that, and this is giving us another probability that on the MACD and on the QQQ, we really did bottom on April 7th. This is giving us more of that. If we cross the 0 line, we cross the 0 line bullish on the QQQ, then I would put that we're in a bear market and this is just a bear market rally. I would put it at less than 15%, maybe less than 10%, guys, because of this right here. Not just that, but we have all this room to run on the on the RSI. We're only at 58.28. If we got a pullback, that would pull us back down to 52-ish, and then we can continue to run up, to overbought 70 plus area, right? And again, these pullbacks will bring us back down here. But in the bear market rally, or the bear market in 2020, we already reached that bottom on the RSI. We already reached it. And if we look at it, we did not bounce as high as we are right now during those two snapbacks, those two bear market rallies. We did not bounce as big as we did. And we didn't, bounce and kind of stay down here. We went, bounced once, and shot back up. Just like during COVID, we went down, bounced once, shot right back up. Another indicator that we did bottom. Last thing, the stochastic is running right through this sweet spot area, right? Back in 2020, we fully reversed right there. We fully reversed here. We went back through. We continued up here. We continued higher. In 2022, during the bear market, right? We came down, we shot up, but then we shot back down, and we came up a big one, and then we curled right back down, came up a little bit more, back down, and then finally broke up and then we're back in a bull market before we had another pullback, right? Again, if we look at this and market, we are still slightly above where we were back during this snapback, this similar snapback that we're seeing right now. So again, if we roll over on this and roll back down, we're more likely this in a bear market than we are during COVID. If we don't cross above the zero line on the MACD and we curl right back down, we are more likely to be in a bear market than we are a COVID V-shaped recovery. If we roll back over on the RSI and cross 50 back down, then we are more so in a bear market than we are getting back to normal and have already bottomed. So yeah, that's my analysis. That's what I'm looking and that's what I'm seeing at on the QQQ. It's the same exact thing for the SPY, so we don't even have to look at that. So that's what I'm seeing, guys. That's why I'm more overall bullish. Not saying we can't have a pullback here, but man, like we're flipping right here to this histogram being green, and to have it go green one time and then not continue to climb green and get higher and build and stack on itself more green histograms, bigger histograms. I don't know. I can't really, it's a moment. These are momentum indicators. And with momentum indicators, it's going to ride the momentum. So yeah, sure. This week, in the beginning of the week, we could get some pullback, peel this off down here. And then next week we're bouncing. And then we're right back to up and up. Or we can keep running. That's the thing no one's talking about. It's the thing nobody's talking about. There's still room on this red barrier. There's still room to climb up there, run into it, and have another solid week that puts us back almost at all-time highs or at all-time highs. There is that scenario because there is a ton of money on the sidelines right now. This is a possible scenario. It is. Monday could go down a little bit, and then we're roaring higher. We just got to continue to monitor the daily and the weekly. And you look at the monthly too. The monthly's back to being bullish, guys. This doesn't happen that often. And this is the last point I'll make on the QQQ and like where the market is. You see how on the daily, it's more sporadic on the Williams percentage range. On the weekly, it's a little bit less sporadic, right? It comes and goes up and down. And the monthly, it's very, very consistent. We're up at the red barrier, Bill Williams consolidation box. Yep, here we go. We're just going to climb higher and higher and higher. And then finally, we broke the Williams consolidation box, bear market. Up, climb back up, bullish, 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 bullish. Broke down. Let me do this one like this. Broke down to the bullish, out of the bullish Williams consolidation box. Massive shot down, followed by a massive hammer candle, just like we saw when? Just like we saw during 2020. COVID, shot down, shot right back up, V-shaped recovery. Shot down, shot right back up so far, and we'll see what happens. But here's the thing. When we came down here and then had this small little snapback and then came down more and then had a bigger snapback and then built a bearish Williams consolidation box and then finally broke out of it and said back in a bull market. It's very different. Again, this whole thing right here, right now is very different than the bear market of 2022. Here, we got more of a snap down, up or bearish, then a snap right back, and now we're right back into heading towards the red barrier with room, and we're right back into the Williams consolidation box. And the only other two times that we've done that where we've passed negative 50 and didn't go into a bear market, continued down, even if we did just snap back up a little bit, because this is a way bigger snapback than this was. And the only other times we did that was 2018 and COVID. So this looks more like 2018 and COVID than it does this, right? And so does a lot of other things I showed you on the weekly. So this is why I'm really just racking my head, and I'm making a pros and I'm making a cons list, or I'm basically making a blue team and a red team, or we can say a green team and a red team, right? If you're a green team, that means we're back, baby. We're back in the bull market. And a red team means this is a bear market and things are going to go lower. There's more marbles being the probabilities and the things I'm showing and the likelihoods and the possibilities and the similarities. There's more marbles in the green side of things rather than the red side of things, the bear market side of things. And if we're talking economics, unemployment isn't spiking. There's a lot of fear, uncertainty, and doubt out there, sure, but housing market's good. Unemployment isn't spiking. Inflation's dead. Tariff talks are getting better. What else? The numbers are coming in good for inflation, obviously. The numbers are coming in good for a lot of things. GDP went negative, and yes, if we get another negative GDP quarter print, then we are technically in a recession. That's the one biggest bugaboo. But banks are holding up good. Credit's holding up good. Just way more marbles on the green side than the red side, guys. I'm just being like open and honest. There's just way more on the green side than the red side. So, yeah, I'm leaning green side. I'm leaning, okay, maybe small pullback, yeah. But man, that was just such a vicious rip down due to tariffs, and tariff talks are way better now than what they were. And now because of that, we snapped right back up. So yeah, those are my thoughts. Those are my views. That's what I'm seeing. I didn't even talk about the VIX. You know, the VIX is dead. The VIX is dead. This, you know, might get a little pop, you know, because of the Moody's information. Maybe fill this gap, then come right back down. But under 20, guys, we're good to go for swing trading and long-term trading. So that's what we're starting to do. You know, it's good to go. The dollar is weak, which it was weak back in. Just another thing here, guys. Look, I mean, in 2022, you had this bear market, and look how far down the dollar fell. And look, it's already done that and starting to recover. It could bounce and roll lower here, but I don't know how far down was this from peak to trough. This was 12.16%, and this was 11%. It is possible that the correction already met all of the bear market standards, because the 2022 bear market, things were way worse. Obviously, the Fed was raising. That was another thing. The Fed is in a cutting cycle. In the 2022 bear market, the Fed was in a raising cycle. So is it possible that this correction met a lot of the same things as the bear market did, and things just got priced in a whole lot quicker, a whole lot faster? So if we look at the dollar, if we look at the VIX, right, they all did the same thing. If we look at the QQQ, how far down it ran, right? The 2-year, 10-year, 20-year, it's been popping up lately, but if we look at it, it is still in a downtrend, which is what we need to see. We need to see this continue to be in a downtrend, right? So I get people are scared, but again, topped out in October 2023, and we're still in a downtrend. The 10-year, a little bit less, but still topped out in 2023, still in a downtrend. If anything, this should really roll over pretty soon. The 20-year, same thing, topped out in 2023, still in a downtrend. Now, if we break above 2023 levels, that's really not going to be good, obviously, for the yields to run. But we're not there right now. So Yeah, back to our trades. And look at this. Bitcoin's up 2.30%. Ethereum is up 4%. And look at these guys. These have room to run. Well, this one we're running into the red barrier, but I still think we get to this measured move of 129,000 from back whenever we got this cup and handle pattern breakout. The measured move of that cup and handle pattern is $128,298 basically. Then you have this bull flag here, and you're breaking out of that. Ethereum's cruising, and look at this. The pendulum has swung from red down to green, and the best time to get in these investments is when you're getting a breakout right here. You're getting a breakout and you are swinging beautifully from green to red, especially when you pass that -50 mark. You better get bullish because this thing is bullish. It's making a bullish cross on the high 5 long term indicator, the high 5L. It's making a bullish cross on that. Last time I did that, it ran up. Last time I did that, it ran up. And here it ran up there too. So falling wedge, breaking out, plenty of room to run. Thing looks beautiful. Ethereum looks beautiful. It's just a little bit late to get in just because you could have this big pullback down. But guess what? Oh, Moody's, blah, blah, blah. Like, crypto's running this weekend.